Good afternoon, Quasar Markets Live. I hope everyone's having a fantastic day. Dr. Ellman, how are you doing today?
Good morning, Howard. Great to see you.
Great to have you here today. It's been a hectic day, hectic weekend, as we know, here in the world of stocks and crypto. President was busy over the weekend. Markets have been moving back down. Um,
Yeah.
You know, it's been it's a time. If you love volatility, this is a time for it. I know you and I, in some of our philosophies, this doesn't necessarily fit the best manner of our investing. But what I love is you and I were talking before we came on about how we can take advantage of the market right now. Could you talk a little bit about what you've been doing with IBIT?
IBIT is a crypto ETF, and I've been using it on weekly options for a couple months now. When the market is normal, which is up 8 to 10% a year, or bullish, better than that, then I typically will sell out of the money covered calls. This way, you have the potential for two income streams:
Right.
one option premium, and the other from share appreciation from current market value up to that out of the money call strike. So that's the way I would typically handle IBIT. And since it has a robust implied volatility, even in normal markets, there's an opportunity to generate pretty significant premium and pretty significant upside. However, we got tariffs hanging over our head right now, and there's a lot of uncertainty in the market. So I've been taking a defensive posture with my trades, not just IBIT, with most of my trades,
Right.
and selling either in the money covered calls or specifically with IBIT deep out of the money cash secured puts. So there's a long ways to go between current market value and when those shares would be put to me at a much lower price and still generating significant income. So, yep, you're
Right.
right, Howard. Defensive posture all the way as it relates to all of my trades and specifically with IBIT.
Absolutely. Okay. Well, we have a great subject to go over today. You're going to go over, and I wanted to do this because I thought I saw your blog post on this, and I thought it brought up a lot of great information that maybe people don't really take into account when they are doing covered calls. So we're going to talk about some of the common mistakes that you find by retail investors when they make covered calls, right?
Yeah, well, I've had the very good fortune of speaking with either at live seminars or online webinars or emails, phone calls, thousands of covered call writers, literally from all over the world. And what I did in the article you're alluding to is I kind of categorized them according to the most common ones. And I selected five of the most common ones, mistakes made by covered call writers. This way I can give new investors a heads up. Be careful about these particular pitfalls because most beginning covered call writers fall into these mistakes and it costs them money. I don't want that to happen. I want them to avoid these mistakes and therefore not get hit with these financial losses, as I did, by the way, when I
Right.
started trading covered
And that's
calls
what I was
back.
going to say is, what you've done a great job of and you do a great job of is, you've developed your system over 30 years and you are continuously tweaking it. And one of the biggest things is you did it as, a retail investor. That's how you started out before you became an educator and now one of the leading experts when it comes to covered calls in the US and quite frankly, the world. So you made some of the same mistakes the same way I did when I got into investing. It's one of the things I think that makes me a good educator is just recently, 10 years ago, I was a new retail trader. So I went through some of these pitfalls that people now run through, right?
Yeah, well, when you make a trade and you lose money, you say, "Gee, that didn't feel good." You
Right.
know, what can I do to avoid that? And that's what I've spent the last 30 years doing is trying to become the best at covered calls and cash secured puts that I could become. And that's the information that I share with you and the BCI community. So yeah, this is a great topic. I'm glad you brought it up and asked me to do a presentation on it. So, number one, probably the most important of the five that I'm going to talk about is that a lot of investors, when they first learn about covered call writing, they want to get started like yesterday.
Yeah.
It sounds too good to be true. Are you kidding me? People will pay me to rent out my stocks. That's it. I get money right away up front. Is that possible? And they don't even ask the question, is there a catch? They go, I'm in. Let's do it. I'm going to
Right.
start tomorrow. So I say, hold on. You're not ready to do this. You got to give yourself about 3 to 4 months for the average beginner. Educate yourself. And so the number one mistake is starting without adequate education. You have to learn the three required skill sets. I'm sure I've mentioned this at previous discussions, Howard, for Quasar. Number one, what underlying security am I going to use for that
Yeah.
option? Stock or exchange traded fund. Then once I have that decision and I have my list of elite performing securities, what option am I going to sell? Am I going to sell it out of the money and in the money? How far out, how far in, and at the money perhaps? So you have to know how to do that. And then once you enter the trade, you have to know how to manage a trade, position management or exit strategies. And I just showed a screenshot of my eighth book, which I know you have and have read,
Yeah.
Exit Strategies for Covered Call Writing and Selling Cash Secured Puts, which is 27 chapters of exit strategy information. So you have to be prepared, not like something happens and you go, oh, I better call Alan or Howard. I don't know what to do. This way you know what to do for every possible outcome after you enter that trade.
And I'll
So,
point out, as you mentioned, I purchased that book when I first met you before we even started this series, and love it, use it all the time. It was a part that I wasn't that familiar with, and that's what I want to point out is, again, you don't ever stop evolving in the world of investing. I am extremely good, in my opinion, at technical analysis and fundamental analysis, but I didn't have a strong way to, I could see that I was losing, that I had positions, I was leaving either money on the table because I didn't know how to maximize them, or I was letting winners turn to losers. And your book really gave me a lot of different ways to mitigate that. So again, it's not just beginners that will learn from this. If I've been dealing with options, like I said, for 12, 13 years now, and thought I knew a lot, but not the type of, and you put it in a way, I talked to you before we came on, you make learning very easy, in my opinion, because you started off as a retail trader before you got, become an expert. And that really helps people, you relate to people, understand their questions before they almost have them.
yeah, I was a dentist before I was doing
Yeah.
this, and I was doing it just for me and my family. And I never thought that I would change careers, but I was very fortunate. And so here I am speaking with Howard Greenberg of Quasar Markets. I've
I love
reached
it.
the pinnacle of my career. What can I say, Howard?
Oh, I don't know if I would call it that, but we love having you. I love our discussions, and as you know, I use your tools and calculators and BCI strategy in my own investing for sure.
Thank you, Howard. Mistake number two, and this is a very, very common one, selecting high implied volatility stocks. I can't tell you how many people have come to me. I got a great stock for covered call writing or cash secured puts. What is it and why? And they'll name the stock. Do you know I can get a 12% 1 month return? And the
Right.
reason that they can get that is because the underlying security has a very high implied volatility. It goes up a lot, it goes down a lot. When there's a high implied volatility underlying security, yes, the option premiums will be juicy. They'll be eye-catching, they'll be enticing. However, there is huge risk to the downside. And I put on this slide, Howard, a screenshot that I'm sure I've used before with you, and that's
Yep.
the risk reward spectrum. And you could see all the way to the left on no risk with treasuries, money market CDs, and then right to the right of that is where we are, my world, covered call writing and cash secured puts. Everything else is riskier. So if you take a high risk underlying security, you're taking where that blue arrow is all the way on the left side for covered calls and moving it all the way to the right, more
Yep.
towards naked options and lottery tickets. Do you want to incur that kind of risk? You're taking a low risk strategy and you're converting it to a high risk strategy. So buyer beware, in this case, seller beware. and avoid those very high implied volatility securities because you're converting a low risk strategy into a risky one.
Absolutely. It's very important to understand that, and it's very important to craft your strategy. And the portion of the strategy that I use with BCI is very conservative compared to my other parts of my portfolio, especially my crypto investments, and that's why it is tailored that way, and that's why I avoid the high volatility plays within there, because I want that to be the safer part of my portfolio, right? So it's important to understand every person is going to be a little different on how you use it. And he's not saying that you can't use covered calls with more volatile stocks. But if you're really using it the way the BCI system does and the way that I recommend you do use it, you want to be using it in the manner that Dr. Ellman is discussing here.
Yeah, well, I mean, if your risk tolerance level is quite high, then you can use very high implied volatility underlying securities. However, my gut is that if that's where your personal risk tolerance is, you're probably going to want to choose a different strategy.
Right.
One that will generally give you the opportunity to generate much higher returns. This is you're not hitting grand slam home runs. I know I've used this analogy before for you. You're not hitting grand slam home runs, but you're hitting singles and doubles all day long. So there's nothing wrong with taking riskier trades if that's where you are, but you have to decide, am I willing to take this amount of risk to get much higher returns, or am I more of a single and doubles guy like Alan is?
And like I've said to you every time, I use the same guy because he was on both of our teams for a while. I'd rather be Wade Boggs sometimes than, Mr. Judge there. I'd rather hit those singles and doubles. He made a lot of money, made a lot of all-star teams, ate a lot of chicken and drank a lot of beer back in the day.
Yeah, well, I don't know if Judge would be a good high risk example.
Yeah, because he
He
hits
hits
good
for
average
average
too.
too.
He
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 hits for
does
average
hit for
too.
good average. You're right. How about Stanton? We'll go with Giancarlo. He's on the injured list on a half year.
Better, better. Okay, common mistake number three, and that's not factoring in earnings reports. Now, most securities, we're not obviously not talking about ETFs because they don't have earnings reports, but stocks have quarterly earnings reports, and there's always a market consensus on sales and earnings growth, and there are averages, consensus. Now, if that stock reports and misses, then of course the value of that stock can go down significantly, and if it beats, it can go up significantly. So here's my point. We don't want to take the risk of owning the stock and having that loss. Now, there are times when you say, you know what, I want that stock for the long haul no matter what. That's fine, but don't cap it with a covered call. Allow the earnings report to pass. If
Yep.
it beats and goes way, way up high, let the price settle and then sell your covered call after that. So you've taken advantage of share appreciation and your covered call premium.
Right.
So not factoring earnings, and it bopped me over the head many times back in the 1990s when I started doing this. Hey, why is this elite performer? I sold the covered call. Why did it go down 10 points in a week? And the
Yep.
answer was the earnings report. So I've learned the hard way to always avoid earnings reports. And that's why this is like the one rule in the BCI methodology is to always avoid earnings reports. Everything else I give you are guidelines. So it gives some flexibility to
Okay.
the investor as to how to manage their trades. And of course, I always tell everybody what I'm doing and how I do it, and then they can go from there.
Absolutely. Yeah. I think it's so important. You can see it in today, what's going on with earnings, right? Even there's such a malaise on the market right now. Even good earnings are resulting in bad performance by the stock prices. So, I couldn't agree more. There's so many stocks out there that won't be reporting in the same week that the stock that you maybe were looking at or already were using. You can still, as you said, hold the stock, just don't write a call against it that week. And you've
Yeah.
talked about it just, there's just no reason. It doesn't, you don't
Well,
need to make
the
it more difficult.
reports that we give to our members, you can see a little snippet of one of them on the screenshot right now, actually is divided by earnings report dates.
Right.
So people know when the earnings report date is and to avoid it. So that's like one of the most important principles in the BCI methodology. So
Absolutely.
you move to slide number 6, which is number 4 mistake, not factoring in diversification. And I found it interesting because you're seeing a little snippet of our 18-page report that we give to our members on over the weekend. So this came out yesterday and was sent to our premium members. You're seeing like just a little snippet of one page. But what I wanted to show you, Howard, and your viewers, is that the first 2 listed there have earnings coming out this contract month. So we list that in gold. In other words, they're eligible, but you have to wait for the report to pass. And then all the way to the right, not shown in this screenshot, gives you the actual earnings report date. So that's why those cells look different. But the white cells below it shows the industry where that red arrow is on the top of the elite performers. And you could see that of the, I think there's 14 or so, like 8 of them are related to banks and finance. So what if we had like 5 stocks in this particular portfolio and they were all banks and finance related? And then all of a sudden that industry segment turns south. Well, our entire portfolio is destroyed. Whereas if we had, software and materials and technology, we had all 5 different industries, we would be protected. If one went down, well, the other 4 can bring us back up. So it's very important to have diversification in our portfolios after we've created a watch list of elite performers. And that data is always in our reports, which the stock report for our members is updated every week. So it's not like it's going to be stale or old information.
One thing I'll bring up too that a lot of people sometimes don't know when they are so heavily in one company or one stock is they'll say, well, I also have maybe an ETF and maybe they have, ARK's innovation ETF, but then they also own NVIDIA and they own Palantir and they own Coinbase. Well, guess what makes up the entirety basically of ARK's, innovation ETF? Those same industry ones. And even when you get to the Mag 7, if you're very dependent in the Mag 7, you have to be careful because those weightings even to the S&P 500, right, are huge.
Yeah. I mean, so you bring out a great point, and that is that, and we're on the same page with this. Diversification is so important. You have to have other industries, not only diversification by stocks, but the industry that stock is located or that ETF is located in. And once you know that that's important, then it'll kind of force you to look and see. Like I'm going to be showing, I think it's the next slide, I'm not positive, actually a spreadsheet that we developed that kind of forces you, here it goes, it kind of forces you
I love it. Yeah.
to make sure that you have good industry diversification, because it doesn't force you to fill in those boxes all the way to the left, but it just reminds you, put in the industry, and then this way you'll make sure that you're not too heavily weighted in one industry. So that relates to diversification. But we're not finished, Howard, because stake number 5 is not factoring in cash allocation, which is different than industry diversification. It's different because what if you have 5 stocks and one of them is $500 a share, and I'm exaggerating now, and the other one is $10 a share, and you have the same number of shares of all of them? Well, that $500 guy, if he goes way down, your whole portfolio is crushed. Forget about it. It doesn't matter what the other 4 are doing.
Right.
So you have to have cash allocation. And my team and I developed this spreadsheet. It's a little snippet of one of our spreadsheets. You see at the top, it's the BCI portfolio setup and results spreadsheet. So this is the setup aspect of the spreadsheets. There are 2 tabs at the bottom where you can go from one to the other. The other one archives your results, but this one helps us set up our portfolios. And this screenshot was taken from an article that I had written a while ago. And at the time, this particular portfolio had $102,217. Now, not shown in this screenshot is the top of the spreadsheet where you put in how much cash do you have, 102, 217. How many positions are you going to use? 5. And it will break it down into the lower part of the spreadsheet, which I'll go through now, Howard.
Yep.
So you see all the way to the left, the red arrow, that's what we talked about to make sure you have diversification. Now, number one is you type in the ticker symbols of the ETFs. And that's where I have this, the second column, number one. And you'll notice they're all the select sector spiders in this case,
Yep.
which break up the S&P into 11 different categories. So those are the ones that were elite performers at the time that I created this screenshot. Now, column where it says 2, which is actually the third column from the left, the spreadsheet will do these calculations for us. That if you have 102,217 available, 5 securities, you want to allocate approximately 20,443 per position. So that the spreadsheet does. Now, under price per share, number 3, you enter the actual price per share at the time you're entering the data into the spreadsheet. Now, a number 4 will be calculated by the spreadsheet. So if, for example, XLC is trading at 87.50 and you have 20,443 to allocate, that means you can buy 234 shares. But when we're selling options, each option we sell relates to 100 underlying shares, as you know. So the spreadsheet will automatically round it up or down depending on if it's above or below 50. So in this case, it rounds 234 down to 200, and that means you're going to sell 2 contracts. But what if it comes out where you're actually, after the initial calculations are done, that you're actually spending more than $102,000, because that can happen. So then there is a final calculation aspect to the spreadsheet, which is actually this one. You could see, let me just take a close look here. Look under XLU. So it's the second row from the bottom.
Yep.
XLU, if you notice under 5 where it says
it was 300.
300 shares. Well, I had to change that to 200 shares because we had spent too much money with the initial calculations. So then that gives you your final calculations, which is telling you that you're spending 99,623, and there's a cash reserve of 2594, which is important because you need a cash reserve to buy back options. If you're going to use any exit strategies, step 1 is to buy back the option. And where is that money coming from?
Yep.
Right.
You have to make sure you allocate for it. That's a huge mistake I've seen in other people when they make trades like this, and not just this, but other complicated option trades. They don't understand what the next step could be that they might need to mitigate. You always have to have powder on the sidelines. We talk about it, with every educator we have here. You should never be 100% allocated because it doesn't allow you to adjust your positions.
Right. I recommend 2 to 4% of your total net portfolio worth. So if you have 100K, then it would be between 2 and 4,000. Here you see 2594. So that worked out perfectly. But remember, I had to make that adjustment with XLU from 300 to 200. So now you have, Howard. Now you have a portfolio that is well diversified. You saw that in column 1. And that also is cash allocation in mind. It'll never be precise. It's not going to work out that every position is going to have 20K, but at least you'll be in the ballpark.
Right.
There's no one position that, if it turns south on us, is going to kill the entire portfolio. And now you've factored in both diversification and cash allocation,
which is so important. And again, I can't stress enough how many retail investors I've seen that have burnt out their accounts because they allow one position to become too big of a percentage of their total holdings, right? And, the way that I try to tell people about it is if you look again at those ETFs, some of these ones that are managed hedge funds and private equity companies, when they put out the prospectus, they will have actual limits that they're only allowed to have in relation to individual holdings, and they will recalibrate it on either a weekly, daily, or monthly basis, depending on the fund, to stay within those ratios. If it's that important for them, we should consider that to be that important to us, right?
Well, actually, it's so important, and I mean, of course, the institutional guys have this stuff figured out already, but that information hasn't been disseminated to retail investors. And
Right.
that really, that's one of this is all a hobby for me. And the business became way bigger than I ever thought it would become, but I just love doing this and to disseminate this information to retail investors. And to avoid the mistakes that I made back in the 90s when I started teaching myself these strategies is a blessing for me.
Yeah.
And so that's one of our goals is to get this information out and to get people to learn how to invest, to hit singles and doubles without learning the hard way, which is the way I had to learn back in the day. So, and then, having an opportunity to share it on Quasar, even broadens the market for us. And is one of the reasons why I just love our discussions, Howard, because I know it's going out to a lot of people because
Yeah.
Quasar is attracting more and more people to its platform. And God knows what that's going to look like in 5 to 10 years from now.
Absolutely. We're so lucky to have educators like yourself. And what we are trying to do is level the playing field for the retail investor, trying to give you the education and the information that you need to be successful. Because too much of Main Street media is about entertainment and not about education.
Oh, yeah.
And that's what they're paid for. It's not to, I'll pull it right out there. CNBC, they don't get paid to predict the stock market. They get paid to put viewers on their screen, right?
Well, yes, and if you notice with some of these programs, you'll get experts disagreeing with each other. So if the experts are disagreeing with each other, that should tell all of us that nobody really knows for sure what's
Right.
going to happen in the near term. Nobody really knows for sure. But what you could do when you craft your trades is you could start doing every little thing, start putting more and more into your strategy to protect you. And then when the smoke clears, you're going to end up getting better results than everybody else by doing these things. And although they may seem intimidating initially because it seems like, wow, there's so much to know, after a while, everything becomes second nature. If you just keep
Absolutely.
doing it over and over again, it becomes second nature. And then the next thing you know is, wow, I don't need Alan anymore. I
I don't know about that, but again, we do want to teach them to fish. We're not fishing for them. You are a person that's big on that. I am also. I'm not telling you what you should trade. I tell you what I am trading or what I'm looking at to make a trade. And that's how you're going to learn. And that's the takeaways we want you to have. Dr. Ellman, thank you so much for sharing your time with us. Like always, we'll be back next week. Have a great week, and hopefully tariffs don't hit tomorrow and the markets start to move up for us, right?
Let's see what happens. Thank you.